All right, guys, good afternoon. Glad you made it. 3 webinars we're going to do today, tomorrow, and Thursday. Part 1, why markets move. Before we go and tell you about myself or anything else, a quick story on the umbrella and sunscreen salesman. Here's a guy who sells sunscreen and umbrellas, and he's got to know how many to pack his truck with before he goes into the city to sell them. He can't do both. So obviously it makes sense to know if it's going to rain. How's that for a rain cloud? Or if it's going to be sunny. So he thinks he's a pretty smart guy and he's going to have an edge over his competition. And he digs in and he finds 50 years of data that says on January 12th, it rains 80% of the time. And he says, wow, this is great. He goes, but I need a little bit more. So he digs a little deeper and he finds this nugget. And this nugget says if it rains on Sunday and it rains on Monday, there's an 80% chance it's going to be sunny on Tuesday. He says, well, that's it. I got it. It's Tuesday. It rained. It's going to be sunny 80% of the time. And on January 12th, 50 years of data, how can I go wrong? So I ask you, after he loads up his truck with sunscreen, wouldn't this poor bastard just been better off looking out the window at the westward sky to see that the clouds were dark? See lightning out west? Of course he would have. And the point I'm trying to make, and the moral essentially of this story, is that data does not make it rain. Clouds do. Doesn't predict the weather. It has to be on simple fundamental factors that make clouds. What meteorologists look at, moisture in the air, wind speed. And so everybody in here would agree on one thing. We're not going to agree on everything. We're going to agree on one thing. We're all in this business as traders to predict where price is going to go. And developing a bias of where price is going to go has to it has to contain why they move. And that's what I'm going to tell you today and over the next 3 days, over the next 3 webinars. Probability and statistical probabilities do not predict rain the next day. Keep it simple. And again, that's what, not that I hope, but that's what we're going to accomplish over the next 3 days. And again, this isn't going to be a very long event with respect to just timing. And don't forget to ask questions if you got them, and we will cover them as we go along. Targets in this 3-part series. What are we going to cover? Today, why markets move. Part 2, understanding how to take that information and understand it better instead of just learning stuff, understanding stuff. And then lastly, on part 3, some examples you could use right away. Some steps that you're going to understand to be able to use the next time you look at a chart in a dome. So back to today. Why is the why imperative? My background in just a slide, floor to the firm, in case you don't know anything about me, my epiphany story, which is really important, how I tripped on the governing principle of why prices do what they do, and then a little bit about tomorrow with respect to part 2. So the why, if you've watched any of my webinars, I often start here, and that's a picture of my family, me on the left, my dad on the right. Why am I showing a picture of my family as my brothers and sisters in the middle? Because he told us growing up, if you know how, you'll have a job, but if you know why, you'll be the boss. If you know how, you have a job. If you know why, you'll be the boss. So over the next few sessions, what is the why? Why understanding leads to action. Forget about learning. It's about understanding from this point forward. And then what are some examples that you could transfer right away instead of sitting on stuff, reading books, and trying to wonder when you're going to put this into action? So essentially, I want to make what's basic to me, basic to everybody that watches this webinar. What's basic to me, basic to you. I've said this before, I'll say it again. The basic most important factors of trading successfully are also the advanced in this industry. Might be the same in many industries, but in this industry that I've done for my entire adult life, what's basic is also the advanced. So keep that in mind. So a little bit about me. I got two pictures of me because I didn't take down the old one. They're only 10 years different though. That's me back when I trade now, a little after when I traded, but I became a board of trade member and trader back in 1999. I was a CME group ARB clerk before that. Became a trader at the board of trade and traded in the pit. I was a pit trader. 1999, the beginning of 2000. Failing miserably, ready to quit the industry altogether. I've been in the industry about 4 or 5 years. And I learn or find out about this office or prop firm it's called, where there's people that are in there, they're given equipment, a screen, and they're backed financially. Now, I didn't know what a prop firm was, and I think many people who get into this business don't know what a prop firm is. And I'm not advocating go out and get hired by a prop firm, but know what a real one is. And a real one, when I became introduced to it, essentially backed you financially, and there was a percentage split worked out. At the time, it was 50-50. You got 50% of the profits, the house got 50% of the profit. And the reason why I'm walking you through this is because while you're not supposed to go out necessarily and get backed by a prop firm, you want to know where the venue is of professional day traders and know what they look like, talk like, what they look at, what's important, and how they review. And a lot of people kind of get stuck on an island alone because they're not too familiar with exactly what the baselines are of what professionals do. All right, so let's get into this epiphany story that I had. And it started with what makes me so special. I'm literally looking at a chart. This is in May. I started in April of 2000 at a prop firm. And a month into it, I'm looking at a screen with a chart, and it was of a rally, just like this, if you guys could see my cursor. And I'm looking at it, and I thought to myself, what makes me so special that I'm going to fade a rally, sell it here, and people are going to come in after me to sell it at a worse or lower price? What makes me so special? What makes me going to sell it at 20, let's say, and people are going to come in after me to sell it at 18 and 16 and 14 and look like that? So a profitable short trade is profitable. And I'm looking at that screen and I'm looking at that chart and I'm thinking, well, first of all, what makes price go up? And I think, and I hope everybody agrees that it's more buyers, it's more aggressive buyers that are chasing the market, just like buying a house. If 3 people are bidding on the house, only one gets it, but the other 2 are instrumental in price behavior, in the direction of price, in this case up. So it made sense when I'm just looking at a rally that, of course, at some point, people are done buying. But it must have been why price went up. And so the other side of it was, well, when that buying is done, if there was a lot of buying, I think it's safe to assume that there's a lot more people that are probably long up here than maybe down here. Now, we don't know that this is a top. Anybody who's traded 5 minutes knows that, but there always is a top. But there's more people long. If there wasn't, there wouldn't have been more buying. If there wasn't more buying, aggressive buying that didn't get filled and finally did, price wouldn't have rallied. So let's go to the most important, I think, slide of not this webinar, but maybe that you'll ever see. And yes, I'm building it up. After you buy it, you're a seller. A lot of people who come to me, they come to me because they heard that phrase, after you buy it, you're a seller. And it made sense to them. Now let's dig into it. After you buy it, you're a seller. Here's some things that we could agree on. First of all, when a price goes up and goes up rapidly, we're all going to agree that it's more buyers and more desperate buyers. It's not just people buying it. Remember, it's people trying to buy it and can't get filled. Let's break up buyers in two parts. Buyers are either going to buy it to open a long position, or buyers are going to buy it to cover a short position. They're looking to open a long or cover a short. Everybody in here, when you're buying it to do one of those two things: to open a long or cover a short. So we know prices are going up because of desperate buyers. Buyers are broken up into people opening longs or covering shorts. What does that desperation lead to? A chase. How many people in here are familiar with that word chase? You could be super successful and you've chased price before in your career. If you do it a lot, obviously you're not having a lot of success. You're chasing price to get out of a short or to get long. The chase is, I think, synonymous with most people. So let's look at it on a dome. 1 second. Let's look at it on a dome. When you get into a market, or when you feel that chase, this doesn't have to be your buy order. These are buy orders chasing it. The market is being bid up, right? The market's rallying. So if I were to put a little illustration on it, just like a chart, the market's rallying. And again, the faster it goes up, the more desperation in buying there is. Now you have to remember, going back to this, they're either opening a long or covering a short. Let's look at just the people opening a long. They're chasing it, right? So once they finally get long, look at a couple things that happened, and I'm going to back it up. Once you get people long and they start opening the position, do you see the sell order that popped up in the upper right-hand corner? After you buy it, you're a seller. When you open a position long, everyone at some point, maybe right away, is putting in a sell order. And if you're starting to get more and more people opening up a long, you're getting more and more sell orders above the market. Did you also see the buying? Let me back this up. Did you also see maybe some limit buy orders below get pulled? If you're chasing the market and you finally get long, you put in your sell order above. You probably pulled your buy limit below if you had one, correct? So what we have here are more sellers and less buyers when this dynamic is playing out. More sellers and less buyers. Now, let's go to this buyers looking to cover a short and the old buy stop. How many people in here use a buy stop to cover a short position, generally for a loser? You can answer if you want, but I would say 80, 90% of the people who cover short positions use buy stops, and generally buy stops are also used to cover that position for a loser. So when you have a buy stop that goes in and it gets elected, like this little stop sign is getting elected, what happens to your buy order below? It goes away, doesn't it? So remember, you're a buyer covering a short in this example. You finally get it elected, which you don't like, and it's order cancels order, OCO. Some people do it automatically, and a buy limit gets canceled below. So another stop is triggered, and another stop is triggered, and the buy orders continue to get pulled. So when you get more sellers above and less buyers below, you create the direction to be the other way. So drawing this, you get the rally and you get the pullback. Maybe this is a temporary top. Maybe it's the high of the day. Maybe it's just a nice swing high. But this is the dynamic of what make prices do what they do. This is the after you buy it, you're a seller with a slide of opening positions long, creates a sell order above, and probably a cancel of a buy limit below. When your buy stop or buy stops by other people get elected, it almost definitely cancels a buy order below. Now, I added something on another slide to go through this again. And that is same text. Buyers looking to open a short. Buyers looking to open a long, or buyers looking to cover a short. Desperation leads to a chase. Same text comes in. Buying makes a market rally. Price now rallies up. All of a sudden, those buy orders are starting to get filled. Long orders are starting to get opened. Sell orders are starting to come in above. And what goes in along with this sell order? What's attached? Let me show you this again. When this sell order goes in, that sell stop is connected. You could ask the question again. How many people, when you get long, you put a sell order in above and you put a sell stop below? You're getting long because you think price is going up. And you want this as your sell limit to get hit because that's your target. That's what makes a profitable long trade profitable. But you put in your sell stop to protect your risk and your downside. It doesn't have to be you that does this all the time. This is what most of the market does. These are the people that we're watching to create an edge as to predict price. This isn't the data of it rained 80% of the time on Tuesday, January 12th, so it probably is going to rain today. No, this is, it's cloudy outside. I see lightning out west. I just called my friend who lives 10 miles west of me, and it's pouring rain. That's the information that you're looking for to predict whether it's going to rain by you. And this is the information you're looking for in order to predict this, the rally and the subsequent pullback. And if you think about this, every time you get a long position opened, you get that sell order in the upper right, long open, sell order in the upper right, stops continue to come in below. So if there's too many longs, there's too many sell orders above, there's too many sell stops below, and it becomes a self-fulfilling prophecy. And we run down. Now you throw on there shorts from down at 4/4. Someone got short here at 4/4. Their buy stop is up here at 17/4. And there's a lot of other buy stops up there. So you just shook out shorts, less buyers. You already got too many longs potentially stuck, and it creates the pressure to go lower. Any questions up to this point? Because up to this point is the whole shooting match. Meaning, when people come to my room, they listen to my analysis. We're going over this every day. We're looking at these spots every day. So someone asks, how do you find the sweet spot? Right here. The moment where you stuck longs and shook out shorts for downside. Dennis? This is not something that, wow, this is something that might happen. This happens. This is the same as how much humidity is in the air and the temperature and the wind speed to predict whether it's going to rain in 6 hours. This is not disputable. The tougher part, right, where this becomes an edge is finding these moments in an area that make resistance or support. But in this case, everybody who's been trading for a while most of the time haven't heard of the markets like this, explained like this. But everybody has heard of support resistance, right? Moving averages, LVNs, HVNs, and everything else to create lines in the sand. When those areas work, it's because this exists. This dynamic exists. When this works, it's not because an LVN was there. It's not because there happened to be a Fibonacci level there. When a Fibonacci level works, it's because this dynamic was present, but not the other way around. This is why price moves. It has to have, and the faster, by the way, a market were to move down, the more longs got opened up here, couldn't get price to go any higher. The more shorts were shook out, which pulled their buy orders below, and it created this, oh no, I'm long, I chased it, I got to get out. It's that rush to the exit. And someone asks, breakout trades? No, these are any trades that create a move, a big move. Yeah, so breakout trades, but fade, picking bottoms, picking tops. And I'm not going to sit here and say to you guys, I advise you to try to find tops and find bottoms, or I advise you guys to play breakouts. I advise you guys to look at trends and pull and buy pullbacks. I'm advising you to do any of those things. I'm advising you to make sure you work on the tools that are going to show you this when you do any of those other things. And the word trap, Brent, is exactly right. Longs are trapped. They're stuck. But it's not like trap is a good word, and I've used it before to have people understand longs that buy it. But you have to understand that they turn to sellers. After you buy it to get long, you're a seller. Because when you're trapped, you can't move, right? These SOBs could move. They're not just trapped. They're trapped and they're trying to bite their leg off to get out. And that's what creates the move lower. So while trap is a good word, or longs being stuck, you got to remember these people are able to move, and it's that movement that moves price. It's too many longs taking their sell orders that puts the pressure on price to run it lower. And where does it drive it down to? Into a collection of sell stops. I want you guys also remember this. If there's a lot of sell stops below, that's a magnet. Why? Because if there's a lot of sell stops, let's say each one of these images down here represents hundreds of sell stop orders. And let's say that's a lot. And let's say we know it's all in this 4 or 5 tick area. And let's say price is up here. Do you know how much of an edge that is? You could trade with your feet if you knew that. Why? Because with every sell stop order here, there's a corresponding sell order above. Generally speaking. Not generally speaking, but because most people use sell stops to exit a trade for a loser, then they're in a trade. So they're trying to sell it higher as a limit to get out of their long trade. But if not, they got a sell stop connected to it below. And you guys know that because most of you guys do it. And it's called an OCO, order cancels order. They're in there together. They go in automatically when most people enter a position. So point is, if there's a lot of sell stop orders below, there's a lot of sell orders above. And if there is a lot, price is going to go down no matter what it's the price of. There's a lot of sellers, there's pressure on that price. Does this make sense to people? There are a few people that said they've been trading for 5 years, been doing this for 5 years, never heard it before. And I'm glad I hear those things because I've been told those things repeatedly. That's why I've gone to the lengths at creating a slide like this to explain it. And another reason why it's an edge is, number one, because it has to be a dynamic that plays out for price to go up or down. Number one, right? Number two, the reason why it's an edge is because most people will never come across it. I don't care how many people watch this webinar, watch this video, see the recording. And you know why? Because I've been doing webinars like this for about 7 or 8 years, and it still hasn't caught. And it could catch, because then people won't really be, Anthony, that's too simple. The simplicity is why it works. It's the tool you find and the reads that creates is the difference. But if you don't have this understanding, then how are you ever going to look for the right tool that shows you when this is happening? You won't. You'll be that umbrella salesman looking at 50 years of data to see whether January 12th has a high percentage chance of being sunny or not. You'll be on that trajectory instead of calling your friend who lives west of you to see if it's raining, or looking at the damn sky. Any other questions? Let me clear this and walk you through it one more time. I want to walk you through desperation buying coming in makes price go up. We've agreed on that. Open long positions and maybe price can't go up. It's putting corresponding sell orders above the market with sell stops connected below. And it's scraping some buy orders below as well. This is trapped or stuck longs. Now, I want you to understand something. The other dynamic is shorts getting stopped out. If you're short, this is a buy stop. When it gets elected, and a lot of them get elected, look what these buy orders below do. They go away. When a buy stop gets elected, a buy order goes away. Buy stop gets elected, buy order goes away. Buy stop gets elected, buy order goes away. Buy stops are to cover a short position. When a buy stop gets elected, they're no longer short. They're no longer short. They're no longer a buyer. That's this that's this part of the equation. The buyer's looking to cover the short. They did it with a buy stop, and it pulled their buy order below there. One more time. Buy stop goes in, buy order goes away. Buy stop gets triggered, not goes in, gets triggered. Gets triggered. Buy limit goes away. Buy stop gets triggered, buy order goes away. Back it up a little bit. A long position's open, sell order goes in, sell stop goes in. Long position gets open, sell order above, sell stop below. Long position gets open, sell order above, sell stop below. This is where, from this day forward, you'll work on getting the best, finding the best tool and the best way to see and find these moments when there's too many longs and shook out shorts. Stuck longs and a short shakeout. That's your job from here, whether it's with me or someone else. That's where your studying and your exercises have to be aimed towards, because this highlights the areas to get short if you're bearish, to get long if you're bullish. If you're bearish and you're trying to qualify a resistance level and it's not working, the work isn't to try to find better resistance levels. The work is to qualify that resistance better. With what? With finding tools and reading order flow to see this dynamic setup. So someone asks, simplicity is the key to financial markets. I'd argue simplicity is the key to everything, but yes, it's the simplicity to trading. Now, I'm not oversimplifying the success you should have. Oh, this is easy. What's the matter with you guys? That's not what I'm saying. I'm saying if you're missing this, stop trading. If you're missing this and you're not understanding this, you're making life almost impossible to be successful. You have to work on finding, creating, and looking and reading the markets with this to qualify you, like a hand coming out of the monitor and slapping me in the head saying, Anthony, with what we're looking at, you just sticking a bunch of longs and price can't go up, and you just shook out shorts. Oh, good, because I'm bearish anyways. All right, well, then sell it. What are you waiting for? So when someone just asks in the chat, is this tape reading? This is the correct way to read a tape. Yes. But not tape reading in the general sense. This is, what are you looking at with all those numbers flashing? What are they telling you? OPP, I want you guys to remember, if you remember anything else from this webinar, other people's positions. Now, for years, because I had my epiphany back in 2000, and then it was almost like you take for granted what you know. I've got some people in this webinar and in our community that are floor traders or guys that traded in the prop firm with me. They know this like the back of their hand. Like any, if here, let me say it like this. If the information gods came down from the heavens and they said to you, we can give you any data you want. What do you want? Before this webinar, I don't know what you would have said, but most people would not have said this, because this is the right answer for the information gods. Give you any piece of data you want. I want to know other people's positions in a real-time fashion. And if they said, well, we don't have that, I said, well, tell me where the stops are. You got it. I'd come to work the next day, take my shoe off, take my sock off, and trade with my feet on the mouse. So all the work that goes into what we do in the edge community, what you guys hope to do as we go forward, as you go forward, is towards this, towards where, at what moment did a lot of people get long and price didn't go up? They got long, they opened a position, because now you know what happens after they get long, right? You know, a sell order goes in above, right? Where's the moment where they get long and the other shorts get short? I'm sorry, get shook out. The other shorts were desperate, chase it up. They get shook out with their buy stop, less buyers, more sellers. Down we go. Less buyers, more sellers makes price go down no matter what it is the price of. And this is what we talk about every day in our trading room. It doesn't mean that some of the tools that you might use to pull in an opinion, to pull in, do you want to get long or short, is useless. But this has to be part of it to make you consistent. And that, part of me likes when I hear people have been doing this a long time and never heard it this way or explained this way or thought of it this way. And the longer I've been helping other people and educating and building this community that we built, the more it's become real that, this has to be what, hey, listen, I'm always working on what my edge is. It all has to do with this. It's all in collaboration to this. How could we take MBO data and filter out certain orders to get a conclusion that it's people opening up this and the price just rallied? Oh, heck. Oh, and also shorts just puked or just got shook out. Oh, wow. That's this. That's your edge. That's your sweet spot. That's your win moment. That's the qualifier of resistance if you want to get short, and so on and so forth. I think everybody would agree that the number one weakness, whether you've been making money or not, is execution. Would everybody agree to that? Give me a yes. Top weakness, even if you're making money, execution is a weakness, because you go into, you're doing well and then you're not doing well and it's your execution is off, right? Well, when people say I'm not reading it well, when people say I'm not executing well, it's because you're not in tune to this dynamic, other people's positions, opening that position and closing that position. And as some people said, there's a ton of yeses in the chat, and then trades too late, which is part of the execution. You're part of the chase. Hey, what this guy, I won't call his first name out, but trades too late. This whole element or dynamic of chasing is put you up here in this example. Trades too late. You're chasing, you get long, you're a seller. It's an uh-oh moment, and this dynamic just played out. You got to know where you're at on the map, and you always got to keep following other people's positions. When I'm trading and when I'm doing the analysis in the room and we're collaborating and talking and different things, I'm not always looking to get into a position. I want trades to find me. But you know what I am doing intuitively is pretending if I was long or if I was short, how would I feel? When I feel like this, I feel anxious if I was long, because a good way to get a read on other people is to get a read on yourself, because we're all human. So if you're feeling maybe nervous if you were long, there might be a chance others are nervous. And you trick your mind as if you were long or if you were short. But you don't always have to have an opinion, and you certainly don't always have to be looking for trades. I got a saying, if you're looking for a trade, once you find it, don't take it. That actually isn't my saying, but someone in the room said that. And that's what's great about great communities, is that as someone who leads it, I'm not always leading it. A leader isn't someone who's always head and shoulders above everybody else. It's someone that's bringing everybody else with him. A great leader is someone who also has the open-mindedness to follow, to listen, as long as you're around good people. That's the criteria, and always working on the stuff that works. You're not wasting your time if you're working on stuff that's going to deliver the instances where this dynamic plays out. You are wasting your time if you're digging too deep into data. And you know that other part, it's the type of analysis, though. The whole analysis by paralysis, people say, and they know because it rhymes. But what does it mean? What does it mean is you're doing analysis that have nothing to do with the movement of what you're trading. So it's not paying you any dividends. You're doing analysis that doesn't have this at its very, very core. Back to the original story of the guy, the umbrella salesman. His analysis was a waste of time, wasn't it? And I'm not saying everybody is wasting their time with their analysis, but most are. This dynamic has to be in place. And the fact that most people wouldn't answer the right question from the information gods, what does that tell you? They don't know what information they're looking for. Because the right answer to the information gods, what do you want, has to be, give me other people's positions. Show me in a dial, Mr. Information God, when people get long, it spins one way. When they get short, it spins the other way. But I know for certainty it's open positions. If they say I can't give you that, show me where the stops are. So we get into this and we'll talk a little bit tomorrow. In fact, let me preview what tomorrow is going to be. If you got questions on this slide, I'll go back to it. But some targets for tomorrow, part 2. Why markets move was today. Understanding this by design. What does that mean? Forget about learning anymore. I don't want people to use the word learn. I want you to use the word understand. Replace learning with understanding. Because the difference is anybody could learn 10 terms or definitions in an hour and you get an A on that quiz. If I told you, here's the terms, here's the definitions, we're quizzing an hour, everybody'd get 10 out of 10. That doesn't mean you understand it. So the best way to understand it is how we laid out this kind of content. And then on Thursday are part three, an example you could use to create your bias. But a little bit of preview to tomorrow, beginning with the end in mind. That's what this understanding by design means. Do you want to learn or do you want to understand? Stop going down all the rabbit holes and books and all the stuff that you think you're missing, because you're not missing that stuff. You're missing this. And then things laid out in a step by step fashion. Begin with the end in mind. And we'll go over that in more detail tomorrow. And it's not just with the stuff I have. You're going to take everything I'm telling you over the next 3 days, and you can invest in what I have or you don't. But you need to invest in stuff that is like that, or now you got a better direction of what you need to be chasing. And it ain't price anymore. It's this edge, the governing principle of what makes damn price move. And it's not having faith in your analysis. It's not having stronger convictions. It's not doing breathing exercises. It's not being more comfortable in your own skin, or yoga, or got to get in better shape, or eat a better diet, or too many carbs before you started trading. All BS. It's knowing and finding the tools that give you a better indication of people opening and closing positions. There's so much I could talk about, and I had to really pull the reins in because you could start really going out, into a lot more stuff that makes this clearer and clearer. But if people don't understand this previous slide I just showed you, well, then the rest is kind of just would be more confusing and irrelevant. And I'll tell you a funny story to show you I'm comfortable in my own skin. When I was looking for a picture for targets, I said, wow, this girl's pretty. I pull it in. It's a cartoon. I said, I'm losing it. Any other questions? I'm either losing it or I lost it. Oh, that is a real person? Nice. Well, it's a cartoon of that person then. Man, Dorian knows his stuff. So that is a, well, it's not, not a cartoon, but a drawing of a real person. All right, here, good questions of people, and hang around for this. What is the best tool? Obviously a ladder. This guy says, and yes, but it's taking the stuff on the ladder, Roland, and being able to disseminate the orders. I don't want to go too deep into future webinars I'm going to do, because I'll make it much more easier to understand in those webinars. But the dome is a bunch of numbers unless you know what they mean and how to read many of them, right? And there's always a better way to see the same thing. So the same thing that you need to work on is this dynamic, right? Convince yourself of that. So then you're trying to find, when you could disseminate buy and sell orders, what are they being used for? Are people getting into long? Let's just stay on the buy side. All right. When people are buying aggressive, are they getting long or are they getting out of a short? Because the reaction to the market, it doesn't matter if they're getting long or short. However, if you do know their stops, then it gives you an unbelievable edge. And we'll talk about the tool that we use every day in our room. But what's more important than talking about the tool is how we got to to showing that these orders are stops. And once you know where the stops are, like I said, you start to be able to take out the randomness that otherwise existed. So I hope you guys enjoyed it. I never know, I kind of prepare for these and build out the slide. And I just, what I've become clear on over the last several years and then several months working with, is that this is not, what's the word? Don't take this for granted. It's basic to me. That's why I said at the beginning, what's basic to me needs to be basic to you. And I had the epiphany, but I had the epiphany because of what people were talking around me. You don't just have an epiphany. It's usually the result of being around the right people, right? And so I was in a prop firm and a floor before that, but I was in a prop firm and hearing and talking about the right things. And you're like, got it. Because I think, not that I think, until you know why you're so special, you're going to feel, it's a zero sum game. No, it's not a zero sum game. You're so special, going back to my epiphany, that what makes you think that you're going to sell it here and people are going to come in after you and sell it at lower prices to make it go down? And it's that previous slide we walked through about for 20 or 25 minutes. You got to know what makes you so special when you pick your areas. And damn it, it ain't the greatest resistance level, because an LVN overlaps a moving average with a 618 Fibonacci, and that's your edge. That's not your edge. That's my edge trading against you. Have a safe evening, guys. We, like I said, recorded this. It'll go up on YouTube. Make sure you got any questions, Anthony at Anthony at edgetradinggroup.com. You guys are registered for this. Those that are watching it live, so you don't have to do anything. You'll get a reminder 1 hour before tomorrow afternoon's event, and enter through that email just like you did today, so you don't have to do anything. Any other questions before we sign out? Let's see. Let me go up. Ron, good to see you. Roland, I hope that answered your question. Stay tuned for the webinars we have. It'll become clearer and clearer just based on best tool. I'm just scrolling up the chat to see if I missed anything. Here's a question that I missed. How do you overcome doubt and hesitation? By stripping out randomness. By understanding that if you know where longs are stuck, that there's sellers that drive prices lower. That if you also know that shorts got shook out, that the market has less buyers below. That's how you overcome doubt and hesitation. If I did a survey, I wanted to say this. If I did a survey in a big room and I said, and a bunch of traders that didn't have my experience or some of the experience of the people in this webinar, get some pretty sharp guys that are in this webinar that are in our group. But let's say it's just a group of people who've been trading for a while, they're kind of inconsistent, whatever. And I says, hey, we're going to get long. Do we want everybody long? And everybody would say, yes, long, everybody long. We'd chant, no. We want everybody that just puked their long, and then we get long. We don't want a lot of competition. That's part of this dynamic. Too many longs, too many sellers. Too many sellers, we're going down. But overcoming self-doubt and hesitation, I agree, it's trusting your edge, but your edge has to be this. Your edge has to include, I keep using the word include. It doesn't have to include this. It has to be this, and everything else you could maybe build on it. Or it's like when you have a resistance line you want to get short, how many times does it get up to your price, you don't get filled, and it would have worked, right? So you missed some of the winners. Got close, you didn't get filled, and it ran lower. So it was a winner, but you weren't on the team, right? And then same resistance line or similar setup. It's a line you're looking to sell it. You got your offer up there, and it blows right through you. So you get it, loser. Meaning you're going to catch all the losers and miss some of the winners. So there's got to be a skill. There's got to be something you focus in and around this resistance level that qualifies, so that if it gets up short, you had a qualifier to get you in to catch that move lower. If it wasn't going to work, you stayed the hell out of it so you didn't catch every loser. Or if it started to work and then didn't work and became disqualified, you were able to get out before it was a full loser. But there's some skill and opportunity that you're seeing based on this dynamic that allows you to qualify or disqualify a trade so it isn't just miss some of the winners and catch all the losers. So while I agree it's trusting your edge, it has to be an edge that has this dynamic that's playing out. Because if the information gods come to you, give them my number one. But number two, if they're only going to give you the information, make sure you know what you're asking for. I would, you know what would be interesting, and not to this group, because I think this group is pretty well versed, but I think that if we had a big group and we asked that question, if the data information gods came down, what information would you want? I'd be interested in the crazy answers they would give these information gods. They give them information, they have that information. They sure that's what you want. Here you go. I want to know how many aggressive buyers versus passive sellers, minus passive buyers. Okay, we got that. There you go. You want people's positions. If you can't get that, know where the stops are. Have a safe night, guys. Keep yourself healthy. Hopefully, we'll see everybody tomorrow, 3:30 Central.